let's get started here with today's webinar. We'll be covering revenue-based funding, also called revenue-based financing, and a whole host of other names. There's a lot of overlap with this type of financing with other types of funding that is really popular right now in the small business lending space. I'm your partner advocate, Craig Blodgett. Most of you have met me by now. I send out regular emails, support you with leads, deals, and product education, and anything else to help make this partnership successful. My contact info is there, and of course, you can reach me at any time. One of the real eye-opening moments for me was when I realized that the global revenue-based financing market size was valued at $900 million in 2019. That was 5 years ago, guys, and it's projected to reach $42 billion by 2027. That's huge. It's I guess average run rate of about 60% growth per year. The industry is exploding, and there's good reason for that. Our goal at Loanspark is to help you guys take advantage of that huge market size, help you guys be able to, provide that funding to your clients and be able to capitalize on that market. What revenue-based funding is specifically, it's a funding category that's a little bit different than your typical traditional financing through the bank, through the SBA, anything like that. A lot of these lenders are going to be considered alternative lenders, and they're going to look creatively at files that maybe the bank would turn away. So there's a huge demand for revenue-based funding, right? We all know the banks are clunky, slow, stuck in their ways, which created an opportunity for alternative lenders to come in and provide financing to businesses that would have been turned away previously, as well as other value adds such as speed, flexibility, and that sort of thing. So the way it actually works with revenue-based funding is the lender will come in and purchase a portion of future revenues from the business at a discount. What this means is that if the lender comes in and purchases, let's say $100,000 of future revenues, they'll give you, let's say they give you $70,000 now, right? So you get a loan that's basically collateralized by the future revenues of the business, rather than, doing a personal guarantee or some sort of collateral or a full underwrite in the financials of the business. Our lenders are more focused on making sure that these businesses are generating revenue, that they have, a plan or some way to pay that back over the course of the future. And if all those boxes are checked, it's a great option in lieu of traditional financing. Specifically, revenue-based funding has a lot of strength with its processing speed. We can close as fast as same day in many cases, which is going to be a huge benefit to your borrowers. Okay, so just remember, although it's not technically a loan, it's a purchase of future receivables, which allows the company or the business, your client, to have access to capital now, which is when they need it, right? So some of the pros and cons of revenue-based financing is, of course, the fast approval process. That's a huge pro, right? You get a customer that calls you and says, "Hey, Robert, hey, David, there's a huge opportunity in front of me. I need $50,000 by the end of the week," right? Your bank typically won't be able to work on that schedule, right? So there's either a really good reason to get a revenue-based loan approved for a business, or sometimes it's on the other end of this. It's on the other end of the spectrum, and companies need access to capital now for maybe a not so great reason, right? We see a lot of approvals for revenue-based funding for payroll reasons, right? Or maybe a tax burden that they need to pay off pretty quickly. Anything that maybe was unforeseen and popped up very quickly, and the business owner really needs to get access to that capital quickly, going to be a great use case for revenue-based funding. Also, with revenue-based funding, there are no prepayment penalties. Typically, what we'll see with a term sheet on a revenue-based funding approval is actually some sort of clause that'll break down a prepayment discount. So, for example, a lot of times, we'll have a expectation of a daily, weekly, or monthly payment. And at the bottom of the term sheet, it'll actually tell the customer, hey, if you pay it off, in 1 month, this is what your total payback looks like, right? 2 months, total payback, 3 months. That way we're incentivizing the borrower to actually, pay off that loan faster so we can deploy that capital again in the future. Also, no personal guarantees are required on these types of loans. This is huge. Things move quickly for a lot of these business owners. There are, sometimes changes that could be happening. I've seen customers come to us looking for capital now to finish up a project before the business is sold, right? So there's a lot of benefits to avoiding a personal guarantee on any type of loan. And then, of course, our application process is very simple, goes hand in hand with the fast approval process. It's going to be pretty low documentation. I'll get into those documentation requirements here in a moment, but it's going to look night and day compared to something like an SBA loan or a longer term loan. And then a soft pull on credit, meaning that when your customer comes in and they apply for a revenue-based loan, it's not going to impact their credit. It's not going to affect them trying to go and buy a house the next month or anything like that. The biggest con to keep in mind with revenue-based funding is the cost of capital. It will be higher than traditional loans in most cases. Sometimes we've seen sticker shock, right? Where a customer who perhaps maybe had a PPP loan during COVID and they're used to a low cost of capital, they realize that maybe those options don't exist for them anymore, or they don't work as quickly as they need them to. And when they come and get approved for a revenue-based loan, a lot of times, they have to really look at that cost of capital and make sure that it actually makes sense for them to take out, that loan. I always say to my customers, I wouldn't take out a revenue-based loan to change the color of paint on the walls, right? You really want to make sure that if you're going to take out a loan that could be a higher cost of capital, you're offsetting that high cost of capital with the benefit or the need for the actual loan, right? So if you have someone who maybe doesn't care about interest rate, they need $100K to either save the business or double the business, this will be a great option for them. If you're looking for someone to provide financing to that maybe has razor thin margins, it may be better to look at other options before going to a revenue-based loan. All right, we'll move into the borrower criteria now. This is going to follow the same format as all of our product guides do. We break down borrower criteria as required and then preferred. Required meaning, you really have to meet this criteria to get your foot in the door. If you don't meet that criteria, chances are there's not going to be any options available. And if you're able to meet the preferred criteria, you'll typically get a higher success rate, more favorable approvals, terms of the approval, and that sort of thing. So let's break it down here. At a bare minimum, anyone who's coming into Loanspark, or really any lender for that matter, is going to have to be in business for about 12 months or so. They're going to need a FICO of 550 plus. So whether that's one owner, two owners, we'll do that soft pull. We need to make sure that they're 550 or higher. And then monthly revenues of $10,000 or more. One thing I want to highlight when it comes to a revenue-based loan, monthly revenues are going to be looked at typically on the bank statements, right? So one of the key things we're going to look for are, number one, how much revenue is being generated. And we look at that by, seeing the deposits, right? So what were the total number of deposits in dollar amount? And then we want to see the frequency of deposits, right? Because a business who's doing, maybe $50,000 a month in revenue, but they're only getting one deposit monthly into that business bank account, they're likely not going to be a good fit for a loan structure that maybe has weekly payback, right? It may be challenging for them to manage that cash flow with consistent payments back to the lender if they're only getting one large deposit in per month. So that's something we're going to keep an eye out for. We recommend, if you have someone doing a lot of volume in credit cards, right, a lot of tiny deposits is always going to look better for a revenue-based loan than, one large deposit per month, for example. And then another thing we're going to look at is the daily balances. We want to make sure that when we're underwriting a file for a revenue-based loan, they have room for a loan, right? We don't want to provide a loan to a business that's, already ending every month with multiple negative balances, or they're, we're seeing non-sufficient fund fees, right? Like they're already having issues meeting their obligations, their debt obligations or expenses or anything like that. We're probably not going to want to put them in a worse position. And, underwriting is going to keep a lookout for those types of ending balances. So again, monthly revenues, there's a lot to unpack there. We're really looking for the amount of revenue, the frequency of deposits, and ending balances. We can work with anything that's over 10K a month in revenue. Would prefer to be focusing on businesses that are making 25,000 a month of revenue or more. And then entity structure is not going to be hugely important, although, being set up as an LLC or corporation would of course help. All right, so you guys have a customer and you've identified that they're looking for a revenue-based loan. As you know, Loanspark's going to work with them to get the documents in, but maybe you're curious, what the application process would entail. It's going to be very simple. This is one of the biggest highlights of this program, as opposed to an SBA loan or, other types of term loans, is the streamlined application process. Credit application, government issued photo ID, 4 months of business bank statements. That's typically all we need to get an approval for $100,000 or less. When we start to get over that $100,000 request range, it's possible that underwriting will request financial statements, maybe some tax returns. It's possible to look at some sort of AR aging report. So, the higher dollar amount request could be, subject to more documentation requirements, but anything under $100,000, typically we can get by with 4 months of bank statements, photo ID, and a completed loan application. Awesome. Okay, one other thing I want to go over real quick, guys. Everyone here on this call has access to the partner portal. If you haven't logged in, I recommend you do so. There's a lot of great materials in there that I recommend you use. And one of those is an industry tier guide. We've broken down basically every industry under the sun into 3 categories. Tier 1, Tier 2, Tier 3. Tier 1 being the highest success rate of that industry. You'll see companies like pharmacies, right? Nail salons, those same types of businesses that are doing a lot in credit card payments, maybe seen as more stable type businesses. Those are really the tier 1 are the ones that we really want to target. So I recommend just taking 5 minutes in the partner portal, going through that tier list and just getting an idea. Think about, okay, well, these are what my customers typically look like. They fall into this tier. And, if they are a good fit and they are in that tier 1, definitely would recommend looking for revenue-based loans. All right, guys, let's jump into some of the use cases. We actually funded a deal, I believe it was this week. It was a $65,000 revenue-based loan for one of our partners' clients in the nail salon industry. They'd been in business for 2 years. And they were doing pretty well. They were actually generating $750,000 in annual revenue. And they were looking for capital quickly. They had an opportunity to invest in some marketing initiatives and really grow their revenue. And there was actually a slight language barrier with that customer. So they wanted to avoid all the back and forth with an SBA loan, right? They didn't want to, have to draft up a business plan and provide financials and this and that. So they opted in for a revenue-based loan. We were able to get them approved in 1 business day. That was, it's very fast, right? And they'll be paying a factor rate of 1.35 on that loan over the next year. Of course, they'll have an opportunity for prepayment discounts. But all in all, the ability for us to get them approved in 1 business day and give them the capital they needed to invest in that marketing initiative was able to help the business, and they're just so thrilled that we got it done so quickly, and we were so accommodating to their their language barrier needs. Another recent funding we did was for $200,000 for a consulting company. This business owner has actually been operating for quite a few years. He was a consultant in management and education and that sort of thing, and he'd been doing about $2.8 million annually. We got him approved for a quick revenue-based loan on a 6-month term. So he'll be paying his cost of capital will be 28 cents on the dollar for that. But he was in a pinch and he needed the capital quickly. So he was in a situation where interest rate was on the back burner, right? Speed of funds and being able to get him the amount that he needed was most important to him. Prior to him coming to Loanspark through a partner, he'd actually gotten a few approvals elsewhere, but they just weren't enough money. It wasn't enough for him to do what he needed to do. So he came to us, and he was just absolutely taken aback by how quickly we were able to give him the capital he needed, which was $200,000. All right. So those are some examples of recent fundings that we've done. We'll cover now just some of our other upcoming webinars. We've got a full schedule here, guys. We'll be covering payroll financing here in 2 weeks. Then we'll do SBA loans the Wednesday in September 11th, which is going to be super exciting. We'll cover SBA 7A as well as Rapid SBA, our streamlined SBA loan program. And then we'll go into commercial real estate loans for the next 3 on September 25th, October 9th, and October 23rd. After that, we'll circle back to equipment financing. We got a lot of great responses from our partners on the previous equipment financing webinar that we did. We've been funding a lot of those deals, so we definitely want to make sure we circle back by the end of